Okay, good morning. Can you all hear me? Yes. No response. Can hear, cannot hear. Good. Thank you. All right. So today, we are going on topic 2, project appraisal, advanced NPV technique and capital rationing. So I hope that you have your questions with you. So we will do very short, only 5 questions actually. We'll do it together, okay, and we see how it goes. So if you have any issues, please stop me and let me know in the chat. All right, let's start with the first question here. So I hope that you guys have your questions with you, because there are a lot of figures that you might want to know how to detect it and how to use it for your solution, and it might be helpful for you in your exams. So the first question here, the mass manufacturing company is considering a new investment. Financial projection for the investment are tabulated here. The corporate tax is 34%. Assume all sales revenue is received in cash, all operating costs and income taxes are paid in cash, and all cash flow occur at the end of the year. All net working capital is recovered at the end of the project. So before I move further, may I know, do you have the same set of questions or not? Because I realized that last week some of you did not get the same set of questions as me. Yeah, who is this student that always put dots and jot things around my marking, around my things? So you better stop interrupting the session. So please do not do anything on my board. I don't know how you get access to it. I didn't make any link to it. So please don't scribble anything on my whiteboard. Okay, so let's go back to the question here. So we are talking just now, we are reading the question here. We realize that the financial projection for the investment are tabulated. Corporate tax is 34%. So list down all these things. Corporate tax is 34%. So you even put it here straight away. Assume all sales revenue is received in cash, all operating costs and income taxes are paid in cash, and all cash flow occur at the end of the year. Okay, so they're telling you all this because you needed to do the cash flow. Okay, you need to do the cash flow. You need to find out the OCF to further identify what is your NPV. Okay, so from the question here, they show you year 0, 1, 2, 3, and 4. Investment $24,000. Sales revenue 12,500 for year 1, 13,000 for year 2, 13,500 year 3, and 10,400 500 for year 4. This is the sales revenue. So you can put your sales revenue over here. Again, this is your sales revenue for each year. 12,500, 13,000, 13,500, and 10,500. You see, the scribbling come again. All right. I know who are you, so I don't want to remove you, but please do not scribble anything on my board at all. You see again. Who is this? Who is this student now with the Chinese name? Yes, you. Yes. Can you respond to me? Who is this? Hello? Hey, hello. Where are you? Can you respond? Who are you? Nah, can see on the screen, right? This name. Name also you never put properly. Do you want me to remove you from the class or not? Who is this student? Let me see. echo on. There's an interruption because these students interrupting the session. They're putting dots everywhere. Hi, who are you? Okay, he did not respond, so I'm off to do this. I don't know who's that, what he's trying to do. Okay, back to our class. Yeah, and who's this also? What with all these funny names? Can you put your correct name properly or not? Who is this? I don't know whether you are from this class or you are some alien from God knows where. I'll give you 1 more minute to respond to me, this student, DZ or whatsoever. So after 1 minute, you don't respond to me, 10, 12, I will remove you also. Hello. No response. Remove. I don't know who's that. An alien from outer space. All right. Okay, sorry for the interruption. Some of your classmates here are not very cooperative. They're interrupting me. So back to the questions just now. Where did I stop? Okay. So I told you, you already know the sales revenue given to you. So you put into your cash flow here to identify your sales. Then the next one is operating costs. Operating cost 2,700, 2,800. Also you can put under here as cost. So just fill in here. You need to know how to do your cash flow, by the way. So you need to roughly know what are the variables here that you want to fill in. And the next one is depreciation. Okay, just copy your depreciation over 6,000 for all years. Okay, information here. So the next one is what? Net working capital spending. Net working capital spending is given from year 0 until year 4. Okay, year 0 until year 4. It should be year 0. So net working capital here given to you year 0 until year 4. Just put down negative. Net working capital will be negative, of course. You should know that, negative 300. Just transfer it over, negative 350, negative 400, and negative 300. This one is unknown. You need to find it yourself. All right. So these are the figures. These are the figures that we transfer from the question to your cash flow. So next, let's look at the question. What question number A telling you? You see participants coming back. Yeah, so there are 2 students that you did not want to clarify your name, especially this one, DHDZ. Who are you? Please change your name and please let me know who you are. Can you respond to me or not? Whoever you are. Hello. Yes, who are you? Then one your name here. Can I know who are you? Tell me now who you are in the chat now. Okay, you say that you can't change your name, so at least you tell me who you are. I know who you, at least give me a name. Navin. Right, Navin then. So why you did not respond to me just now? What took you so long to respond? Okay, so Navin responded, then never mind, we let him stay. All right. So any hinky pinky more coming after this, I'm gonna remove and block straight away. It's your own responsibility. You just only entered. Just now you were here. I was talking. I was showing your name. I was asking so long until I remove you. All right, come back to the class. Okay, there's a lot of interruption for the past 15 minutes. All interruption from students. So let's go back to here. So the question A, compute the incremental net income of the investment for each year. So the first thing you need to find the net income for all of these years. B, compute the incremental cash flow of the investment for each year. So you want to count the incremental cash flow. This is the two things you want to know. Net income, incremental cash flow. Without these two, you cannot find the NPV. And lastly, suppose the appropriate discount rate is 12%, calculate the NPV. So you need to find out the net income and incremental cash flow before you can calculate your NPV in the end of the day. All right. So once you got all this in place, it's actually very simple. All right. It's actually very simple. So cash flow is usually sales minus your cost. So this is minus cost. I cannot put minus here because you, yeah, I see. The problem will be like that. So I put a symbol there. So minus cost, that means this one you put into, this will be negative. Okay. Depreciation also you need a minus. So to find your earning before tax is basically sales minus cost minus depreciation. Then you get your EBT. EBT means earning before tax. So 12,500 minus 2,700 minus 6,000, you get 3,800. All right. Same for this, 13,000 minus 2,008 minus 6,000. Then you get 4,200. Year 3, 13,500 minus 2,009 minus 6,000. You get 4,006. And lastly, 10,500 minus 2,100 and then minus 6,000. You get 2,400. So this is your earning before tax. Okay, refer back to your question. They tell you that the tax rate is 34%. So tax rate is at 34%. Do it one by one, step by step. All right, 34% of 3,800 is how much? 34% of 3,800. $1,292. Okay, 1,428, 1,564, and 816. So what is your net income? So you need to deduct the tax, right? All right, this is negative. Always need to deduct. So you get 2,508. Drag across. So of course, like in your exam there, you cannot use Excel. You need to go and do one by one, do a calculation one by one. Okay, so this is what you get for your net income. All right, that's the net income that you get. So after getting your net income, of course, operating cash flow on year 0 is going to be 0 lah. So what is OCF? OCF is basically net income plus depreciation. Okay, operating cash flow is net income plus depreciation. So in this scenario, you just use your net income plus back your depreciation. So 2,508 plus 6,000. I cannot because there's negative reading. So you're gonna screw up my number again. So you're gonna be 8,508, 2,772 plus 6,000, 8772. 3036 plus 6000, 9036. And 1584 plus 6000 is going to be 7584. Okay. All right. Capital spending only in year 0. Your initial down investment on this whole project is $24,000. Okay, $24,000. So, net working capital, what will happen at the end of the day? All your net working capital in from year 0, 1, 2, 3 will be assumed that you will receive it back on the final year. So on year 4, you're going to be a positive one. The total of what is 300 plus 350 plus 400 plus 300. So 700 plus 1000, 1000 plus 350 is 1350. At the end of year 4, you'll get back all your net working capital. 1350. Okay? 1350. All right. So now, incremental cash flow. How to count this? Total sum of all this will get you incremental cash flow. Equals sum. I think I'm using the right format. All right. Okay. So at the end of the day, these are the cash flow that you're getting. These are the things that you're getting in. So you put into a timeline. Okay. Year 0, 1, 2, 3, and 4. Your cash flow will be 8158, 8372, 8736, 8934. Initial investment 24,300. Interest rate is 12%. So calculate your NPV. Okay, calculate your NPV. So now to calculate NPV, you know, NPV equals to negative 24,300. Okay, plus 8158 divided by 1.12 power of 1 plus 8372 1.12 power of 2 plus 8736 1.12 power of 3 and 8934 1.12 power of 4. So total all these up together, see whether can you get a positive NPV or not, to see whether should you reject or accept this project. Okay, so some of you might use calculator. If you know to use your calculator, you can use your calculator. If you don't know to use your calculator, this is the manual way to count your NPV. So in the end of the day, what is your NPV? You tell me. Come. So who already calculated? What is your NPV? Hmm. 5 minutes. You give me your NPV. Today got 5 questions. Got plenty of time. Okay, 5 minutes to give me your NPV. One five five 3.87. Yep, very good. So 1553.87 is a positive NPV. So you can accept this project. Okay, the NPV for this project is 1553.87. So you can accept this project. Okay, so anyone have any issue so far or any difficulty understanding? Any questions? Anybody? No questions. Very good. Okay. Hopefully that you understood what is going on. Okay. Then we move on then. We move on. Today, all the questions are actually very similar. So let's look at the next one. So just now, my mood is a bit affected by some of the technical issues just now. So never mind. Hopefully, uh, you're not affected by my bad aura. So now, let's start it back normally. So let's go to question number 2. Hovel Petroleum is considering a new project that complements its existing business. The machine required for the project costs $3.8 million. Okay, the cost is $3.8 million. The marketing department predicts that the sales related to the project will be 2.5 million per year for the next 4 years, after which the market will cease to exist. Okay, they will get sales of $2.5 million. So the machine will be depreciated down to zero over its 4 years economic life using the straight line method. So you need to use 3.8 divided by 4 later to count the depreciation. Cost of goods sold and operating expense related to the project are predicted to be 25% of sales. Hovel also needs to add net working capital of $150,000 immediately. That means in the first year itself or in year 0. The additional net working capital will be recovered in full at the end of the project life. The corporate tax is 35%. The required rate of return is 16%. So how should Hovel proceed with the project? So basically, you find NPV again. Okay, you need to find NPV again. Okay, so first of all, you need to count how much you need to spend at the initial investment. So this machine is $3.8 million. Okay, your net working capital $1,853.87. How come? Should be some you calculate wrongly already for sure. It should be 1,553.87. You got the rest of it correct, only 1,853. So I think it should be, yeah, I think anyone use the calculator. If not, what they're going to use. So I'm pretty sure it's your input error. Please try it again. You must get 1,553.87. Okay, so back to question number 2 here. You know, initial investment here going to be 3.8 million on the cost of buying the machine, and then you must include $150,000 net working capital. So in total, it involves you to use 3.95 mil. This is the initial investment. Okay, this is the initial investment. So now let's count the what do you call that? Let's count the NPV. So again, you use cash flow to count your NPV. So the question tell you just now, let's look back at the question. The marketing department predicts that the sales related to the project will be 2.5 million per year for the next 4 years. So 2.5 million. So this is million now. I already put the 30, right? 2,000, 2.5 million. Okay, 2.5 million, 2.5 million, 2.5 million. It's going to be the same across all 4 years, according to the question here. All right. Then talk about the COGS. Okay, the cost of goods sold and operating expenses related to the project are predicted to be 25% of sales. Okay, so it's 25% of sales. It's going to be fixed across again. So 0.25 multiplied by your sales, you get 625, and it's going to be same all across 4 years. Okay, next is the depreciation. So how do you want to count the depreciation? Very simple. So it's going to be depreciated across 4 years. So 3.8 million divided by 4. So each year the depreciation will be $950,000. So put it here, depreciation 950. Okay. So until here, you already can get your EBT, your earning before tax. So to make it simple, let me show you if it's a negative or is a minus. I put it in red. So I highlight it in red color. So that means you need to deduct this. Okay, in your EBT, you take your sales minus off the rest. Formula still. Okay. How do I do this? Equals to mm-hmm, 925. So it's going to be the same because all is fixed amount. All is the same amount. All right. So your earning before tax will be 925 for 4 years. So the tax is 35% of 925. It's going to be the same again. Very simple question. Equals 0.35 multiplied by this close bracket 323.75. Okay, so this is 300,000, 323,750. Okay, so now with this you can calculate your net income. Okay, the net income is earning before tax. This is your tax, so this is going to be red color. You need to deduct this. Okay, equals to EBT minus the tax 601.25 or 600,250 dollar. Okay, add back your depreciation to get your OCF. All right, add back the depreciation. Depreciation is 950. So 950 to count OCF. OCF, I told you the formula is net income plus depreciation. So add back together. Oops. Get 1,551 1,551,250. 1,551,250. Okay. Initial investment just now, I told you you need to put in the cost is 3.8 million. So this is negative. Okay, negative, we're going to put 3.8 million. Red color. Net working capital, initially, you need to be red color also. Okay, how much is net working capital? 150. So just put 150. At the end of the year, you will get back the 150. Remember this. The net working capital at the beginning, you're going to be negative. At the final year, you'll get back everything. Okay, so total cash flow after tax. This is equals to equal sum this is red in color because it's negative. Okay, this is red in color. All right, so now you get the total cash flow already. Do NPV again. Okay, do NPV again. So NPV at 16%. Okay, NPV at 16%. So negative 3,950,000, 3.95 million plus 1,551,250 divided by 1.16 power of 1, and then 1,551,250 divided by 1.16 power of 2, 1,551,250, 1.16 power of 3, and the last one is 1,701,250, 1.16 power of 4. Find out whether is this a positive NPV or negative NPV. Again, find out is this a positive NPV or negative NPV. 473.552. Okay, so February Wong get 473.52. But you need to change. Again, this needs to be multiplied by 1000. So it should be 473.520. Okay, February using decimal point, right? 1551.25 only, right? Just now. Yeah. So need to multiply by 1000 because there's 1000 here. Okay, this is already simplified. So it's supposed to be 2.5 million. This is 1.55 million. So multiply by 1000, you get 473,520. This shows positive NPV. Oval can accept the project. Can, huh? Oval can accept the project. Okay, the rest. Can you get it or not? Very good. Okay, very good. Can get, very good. All right. Yeah, it's actually very simple. Okay, it's going to be repetitive. The next question is a bit different. Next question, no more NPV. It's EAC. So, Vanderlei Industry is considering the purchase of a new machine for the production of latex. Machine A costs $290,000, $2.9 million, and will last for 6 years. Variable costs are 35% of sales, and fixed costs are $195,000 per year. Okay, so variable cost is 35% of sales, and fixed costs are 195 per year. So machine A, I already put there, 195,000 per year. Okay, machine B costs 5.7 million and will last for 9 years. The variable costs for the machine are 30% of sales, and fixed costs are 165,000 per year. Again, I already put it there. The sales for each machine will be 12 million per year. So just now, machine A, they tell you the variable cost is 35% of sales. So 35% of 12 million will give you 4.2 million. Okay, this is the variable cost. All right, for machine B, it's only 30% of sales. 30% of $12 million is $3.6 million. Okay, this is how you get the variable cost. All right, variable cost is a percentage of the sales. Then following on, the required rate of return is 10% and tax rate is 35%. So tax rate is 35% written there. Okay, the 10% here is your NPV lah. NPV requirement is 10%. Both machine will be depreciated on straight line. Okay, both machine will be depreciated on straight line. If the company plans to replace the machine when it wears out on perpetual basis, which machine should you choose? Which one will give you a better option? So variable cost just now, I told you already, variable cost for A is 35% of $12 million. So you get 4.2 million. Variable cost for B is 30% of 12 million. So you get 3.6. Fixed cost is given to you. Depreciation is the other thing that you need to count. So for machine A, the cost of machine A is 2.9 million divided by 6 years. Then you get 483,333. This is machine A, depreciation. Machine B is 5.7 million. But then for 9 years. Okay, for 9 years. So the depreciation for each year is 633,333, which is these two. Okay, so since you need to calculate EAC now because you're comparing two different machines. All right, you're comparing two different machines. So you don't use sales anymore. Okay, you don't use anymore. You don't use sales anymore. You're comparing on EAC here. All right. So when you do EAC, you no need to use the sales. And what is EAC? What is EAC? Okay, EAC also mean as equivalent annual cost. You want to know that each year which machine will cost you more. So you need to calculate the EAC then. So in this case, you don't use the sales, you just total up all of this together. Okay, so it's negative, it's all negative, so equals sum you get a total of earning before tax, or this is both of these negative figure, because it's also negative figure. All right, so how much is the tax? 35% of this. Oops, 0.35 multiplied by, this is the tax amount. Okay, then you get your net income. All right, net income is this negative figure minus this off. So just do regularly. Okay, so it equals to this one minus this. All right, net income also negative. Okay, add back depreciation. Add back depreciation. All right, so it should be negative plus positive, right? So equals to this is operating cash flow, but it's in a negative figure. Okay, it's in a negative figure. All right, so once you got until this stage, you got your operating cash flow already. Okay, you need to find out the NPV now before you can get your EAC. All right, what is the formula for EAC? Equivalent annual cost is actually equals to PV divided by PVIFA, interest, and period. Again, this is the formula for EAC, equivalent annual cost, present value divided by PVIFA, percentage and time. Okay, so in this question, one is 6 years, another one is 9 years. So count one by one. Let's do NPV A first. Do for machine A first. So to find NPV for A, okay, your initial investment is negative 2.9 million. All right. Okay. And then, because your operating cash flow is also negative, so minus, discounted it backwards for the next 6 years. 2,687,583 multiplied by PVIFA, 6 and 10%. Okay, 6 and 10%. Because they tell you the required rate of return is 10%. Okay, so I hope that you guys know how to use a PVIFA table. All right. If you never see a PVIFA table, this is how the table looks like. It's a bit small here. Okay, PVIFA table here. So look at 6. Okay, this is the period 6. Look at 10%. All right. So the amount is 4.3553. 4.3553. All right. So 4.3553. Okay, negative 2900,000 minus 2687,583 multiplied by 4.3553. Something wrong here. Figure too big. 11 point, yeah, wrongly, 24.24. Okay, so this one, 11,705,230.24. Okay, so you add on negative, negative, so it's, oops, why is it not counting? So in total, negative 14,605, 230.24. Okay, this is the negative NPV you get. All right, so this is the present value. So now you're gonna get the EAC of A. Take this figure, negative 14,605, 230.24. Oops, 0.24 divided by the PVIFA again. Okay, the PVIFA, which is 4.3553. 4.3553. So 14 divided by 4.3553. Then you get this figure. 3353,438.40. 3353,438.40 is negative amount. This is for EAC for A. Okay, EAC for A. Now repeat this process to find the EAC for B. You want to see which one will have a lower EAC. Okay, the lower EAC will be the one that you will choose to invest in. So NPV A, EAC A, you can get ready. Now you do NPV B. No space. You go down. Also no space. All right, just go here. So NPV B, repeat the whole process again. Okay. Initial cost for NPVB is $5.7 million. Then you minus off this figure, 225,583. Use the PVIFA table again. But this one is for 10% and for 9 years. Okay, 10% and for 9 years. So let me show you the PVIFA table again. Nine years for 10%. 9 years for 10%. 5.759. 5.759. So take this figure, put into here. $5.759. Correct? No, I never see the wrong one. Yeah, 5.759. So calculate again. Step by step, one by one. Doing together with you. Where's my calculator? Two 5583 multiplied by 5.759. Okay, so you get 12817,132.5. Add your 570000. So 18 mil. Negative 18517,132.5. Okay. So EACB will be this figure divided by 5.759. Okay, this figure divided by 5.759. You get negative 3215,338.17. 3215,338.17. So which one is smaller? Which one is smaller? A or B is smaller? No lah. Okay. This is a mistake here. Assuming that the negative does not present here. Which one gives you a smaller figure, smaller number? B. Okay, B. All right. Of course, if you look at negative 3353 will be a much more smaller number. But ignoring the A now, ignoring the negative now. Yeah, ignoring the negative. So B will actually cost you a little bit lesser. Okay, it costs you a little bit lesser. It only costs you 3.215. Okay, 3,215,338. So what is the negative means here? The negative actually means the cost to you. This is the cost to you. So if you use A, the cost for you to use machine A will cost you to spend 3,353,438.4 per year. For the whole session. Whereas for B, you are spending 3,215,338.17. Okay. So this is for a year. Effective annual cost. Again, effective annual cost. So machine B will be cheaper. So in this case, you should opt for machine B. All right. I know it's very long. It's a lot of calculation, very confusing sometimes. So these are some of the things here that you might want to pay close attention to. So know how to read your PV-IFA table. It will help you a lot. Okay, simplify works a lot. All right. And then remember what is the negative means here. It means costing to you. Again, it means costing to you. So if they call you to count a comparison between machine, you want to count the costing, usually you must use EAC. Okay, you use EAC to make a comparison on which to invest, which one costs you more, which one will cost you less. So can you follow or not? Okay, you see why tax is being added in instead of being deducted, right? So actually, it's being deducted. So all this negative by right is supposed to be positive only. Then the tax is deducted. So in this case here, it's the other way around already because all is in negative form. If you realize, you see variable cost, fixed cost, depreciation, okay, is all negative. Then the tax is positive only. So basically, in this case here, you just want to reverse it because you deduct some more. That means you got more. That means it's not your net income anymore. You see your earning before tax. By right now, if it's in a cash flow, if it's in an official cash flow or correct cash flow, when there's earning before when there's a negative earning before tax, how can you tax anymore? If you're not making profit, how can you tax a company? Makes sense or not, Eden? But in this case here, we are counting the costing. That's why everything is a bit reversed. It's the opposite side. All right. If in the actual cash flow, if you are having a negative earning before tax, there's no tax anymore. How can you tax a company with a negative earning? So in this case, there is still taxes because it's the opposite already. This company is not losing money. They are having profit. But the problem now, you want to count how much it's going to cost you for each machine. That's why it's a bit different here. Okay, good. All right, it's a very good question here. It's a very good question. All right, so moving on. You're welcome. Okay, you're welcome. So moving on, the next one. The next one is very, very taxing. The next one is for 10 years, or for 8 years, sorry. Okay, it's for 8 years straight. So United Pig Pen is considering a proposal to manufacture a high-protein hog feed. The project would make use of the existing warehouse, which is currently rented out to a neighboring firm. The next year rental charge on the warehouse is 100,000, and thereafter the rent is expected to grow in line with inflation of 4% a year. Okay, so rent is 100,000. Okay, see, year one rent is 100,000. So each year it's gonna be incremental of 4%. Incremental of 4%. All right. So if it's incremental by 4%, year two, it will be 100 multiplied by 1.04. Oops. Okay. Year three is equals to, oops, this figure multiplied by 1.04. Okay, inflation of 4% per year. So you keep going up. I hope that I get the right one. Okay, so we don't want to have the percentage. Yep. Okay, this one should 112.5 should be 113. Oops. 1317. Yeah. Okay. So this is the rent. Okay, we do the question one by one. We fill into this table here. So first they talk about rental, which is 100,000, and then it increased by inflation of 4% a year across 8 years here. Okay. In addition to using the warehouse, the proposal envisaged an investment in plant and equipment of 1.2 million. Okay, they were in $1.2 million investment on the plant equipment. This could be depreciated for tax purposes straight line over 10 years. Okay, so 1.2 million investment, which could be depreciated across 10 years. So each year is $120,000. Okay, $120,000. So depreciation is $120,000 across the 8 years, because they want you to do 8 years only here. Okay, next. However, Pigpen expect to terminate the project at the end of 8 years. Now, that's why we do 8 years only. Okay, they want to terminate at 8 years and to resell the plant equipment in year 8 for $400,000. So they want to sell this thing at $400,000. Okay, at the end of 8 years, they will sell $400,000. So the initial investment at year 0 is $1.2 million. This seems to be negative. All right, this is the figure here. Okay, so let's continue reading. Finally, the project requires an initial investment in working capital of $350,000. So working capital, $350,000 in the first year. All right. Okay. Then, what is the next information here? $350,000. Thereafter, working capital is forecasted to be 10% of sales in each of year 1 to 7. Okay, your working capital is 10% of your sales. All right, so what is the sales here? What is the sales? I won't given you that. So year one sales of Hawkfin are expected to be 4.2 million. Year one sales is 4.2 million. Okay, 4.2 million. And thereafter, sales are forecasted to grow by 5% per year, slightly faster than the inflation rate. So here will be all right. Okay, this is your sales. Every year increment by 5%. Okay, every year increment by 5%. So this is the total one. All right, for all the next 7 years. Yeah, all the way lah. So manufacturing costs are expected to be 90% of sales, and profit are subject to taxes at 35%. Cost of capital is 12%. Okay, what is the NPV of the project and should they proceed? So manufacturing cost here is 90%. 0.9 multiplied by total sales. Oops. Okay. Now you can count your earning before taxes already. So of course, all these need to be deducted. Okay, all these need to be deducted. Red color. So earning before tax is equals to sales minus manufacturing cost minus depreciation minus rent. It's $200,000 left for year one. Drag across, let them calculate for me. Okay. So taxes equals to 0.35 of my earning before taxes. Drag across. Okay. So we don't want it to have any decimal point. Convert it like that. Okay, converted. So all highlighted rate because it's spending. So profit after tax is equals to 200 minus taxes. Drag across again. Okay, once you got all this, add back your depreciation. This one is the depreciation 120. Copy, put back here. Right, this one add one into automatic black color. The cash flow operation now you can get equals to all right. So until here, you already get your cash flow. So now working capital are having some issue here. All right. So what did they tell you about working capital just now? Look back at the working capital. So working capital is 10% of sales. Okay, is forecasted to be 10% of sales in each of year 1 to 7. All right. So working capital is your sales, 10%. So equals to 0.1 of your sales. So this will be dragged across to 7 years. Okay, drag across to 7 years. All right. So in the final year, no working capital because you already sell off. You're supposed to get back the total amount. Okay, the total amount you should be getting back here. All right. So you need to know the increase of your working capital. So of course, this one is 350. Okay, this one 420 minus 350 is 70. 441 minus 420, 21. 463 minus 441, 22. 486 minus 463, 23. 5.1 minus 486. This one is 25. Correct. 5.1 minus 486. I cannot count. 25. Thank you. Again, 25. 536 minus 511, 25 again. 563 minus 536. 27. Sure. Thank you. Okay. So, all these are negative. Red color. Only the last one here going to be positive. So, positive by how much? Equal sum of all this. 563. So, in the end of the day, 563 will be received back on year 8. Okay? All right. This is it. Okay. So now, the problem here, we got all these figures done already. Okay. This working capital don't include only this. So now, what should we do now? What should we do now? Why the working capital in year 8 is 0? Okay. You see, working capital is in the final year, when you close your account or when you sell off any assets, that's where you receive back your working capital. So working capital is basically an amount that you needed to use it when you are having that machine, or initial investment that you need to use. You need to spend a certain amount first. By the end of the year or the end of the period that you sell off the machine, you'll get back all of it. You're assuming that you'll get back all your working capital. That's why in the final year of year 8, you don't include any working capital, but in fact, you're going to receive the total lump sum back. Can, Brian? So remember this, whenever you do a when you do a cash flow, at the end of the final year, when you do the selling, when you close your account and whatsoever, that's where you receive back all your net working capital. Okay? So irregardless of whatever working capital you've been using all this while, at the end of the day, you'll get a total net working capital. You'll receive back everything. All right. Clear? So why do we use the incremental here? That means basically each year they are using this extra amount only of working capital. Again, that's an incremental of new working capital only. Okay, this is the initial one, initial cost. Okay, so each year there's an incremental of this amount, this much amount. All right, so one thing now that we're missing is we need to find the next thing here is the tax on gain. Okay, tax on gain is when you sell something. All right, when you sell something. Okay, so what is the tax on gain? When you sell something, okay, you get tax on the gain lah. Okay, so the book value at the end of year 8. Initial investment 1,200 minus 120,000 of depreciation multiplied by 8. Okay, so how much you get here? How much you get here? Gain on your sales minus of your book value. So salvage value is 400 ma. So we want to see how much of tax gain you can get from here. So let me see, where's my calculator again? Hey, why is this coming up Google instead? Calculator, 120,000 for 8 years of depreciation, 960,000. Okay, 1.2 million minus 960,000, you get 240. Okay, you get 240. All right. So this one to 1 lah. 120 times 8 assuming the 00 is not there. So it's 240. Okay, it's 240. 240 also known as 240,000 actually. Okay, but because when we do the cash flow, we already take out the 30 at the back there. So it's 240. All right, your book value at the 8th year is 240. Okay, how to count the book value at end of 8th year? You take your initial investment minus of your depreciation. So 8 years of depreciation of 120,000 what? Okay, so still value at 240. At book value is value at 240. But then you finally sold it at $400. Salvage value is $400. So how much gain you get from there? How much gain you get from there? Okay, salvage value minus book value. So this is equals to 400,000 minus 240,000. So it's actually having a gain of $160,000. All right, you have a gain of $160,000. So this $160,000, you're going to be taxed. Okay, you're going to be taxed. 160 times with the tax is 35%. So this is going to be 56. Okay, so your tax on your gain here is $56,000. So you need to know why you're being taxed. Because you're getting a gain from selling of your assets. So any asset sold will be taxed, okay, on the gain. So to count the actual gain, you basically use the salvage value minus the book value. So this is the tax on the gain. Okay, so now moving on. Calculate the next cash flow. Okay, the net cash flow here. So basically, the net cash flow here is this. Initial investment, okay, this working capital one, you don't do anything anymore. This one, you ignore. Okay, you totally ignore about this. You straight we talk about increase in WCNE. So this working capital is just to show you each year, each of the working capital. How do I cross it? Don't have to cross line. So basically, you just don't ignore this, ignore this section. Okay, so net cash flow, how much you initially invested? $1,200 and your working capital of $350. So your net cash flow here is 1550, and this is money outflow. Then every year, money inflow is how much? Money inflow is how much? So what you do is you take your cash flow operation minus of your incremental of your working capital, track it along. Okay, and then the last year will be 563 plus 400, okay, plus 341 minus 56. All right, so this is equals to 341 plus 563 plus 400 minus of the tax on gain. So you want 248. Okay, so to make life easy, to straight count the present value, you can use this discount factor. Okay, discount factor. So basically, this one in year 0, no discount factor lah. Okay, power of 0. So divided by 1. Your present value here will be 1550. The rest of this will be discounted backwards. That means 180 divided by 1.12 power of 1, and so on and so forth. So let me see, can I use this? 1 divided by 1.12. I don't know how to change this. So basically here is 1 divided by 1.12 power of 1. Okay, then cannot change the figure. How do I change the figure? I've forgotten how to do this. Okay, so not a good idea. Not a good idea to do this. Power 1. Okay. Let me figure this out. Hold on. 2 close bracket, power of 1, close bracket again. We found a typo. Okay, I got it. I got it. Okay. So this is discount factor all the way, and then this is NPV lah. Basically, you do one by one because it's 8 years. Very texting. You want to write one by one, it's going to be very long. All right. I'm using Excel, so it's going to be easy. But if you're using it in, if there's no Excel for you to use, you need to do one by one. One by one. Okay. 180 divided by 1.12 power of 1, 240 divided by 1.12 power of 2, and so on and so forth until power of 8. So in this case, it's easier for me. So basically, I just take, this divided by this. No, multiply, sorry. Multiply by this. So 160.71 all the way to the 8 years. Rounding up close. This is what I get. So now I want to get my net present value. Okay, my net present value is basically equals to negative this figure plus 161 plus 191 plus this plus this plus this plus this plus this plus this close 86. Okay, so my NPV is 86. So should I invest in this project or not? It's a positive one. Yes, definitely you need to invest. Okay, definitely I can invest in this project because it's a positive NPV. So it's very long, very lengthy, very taxing also, very tiring. Okay, I don't know how many of you are paying attention to me talking to myself. It's quite depressing where I cannot see anyone and I still need to deliver it to you. All right, so anyone have any issues so far? I think it's pretty similar to previous questions, but just that this is a bit longer. So anyone having any difficulty understanding so far? Anybody? No issues. Everyone cool. No questions. It's a lot. It's actually not a lot. You just need to read the question one by one. Read through the question step by step, find out what they want. Can I explain that? Okay, so you see discount factor, you see the formula here given to you. Let me show it to you. The discount factor that I give you is 1 divided by 1 plus 0.12. So this is basically your 1 plus r power of t. Okay, so to make it easier in the table or in Excel for you to calculate, I basically changed it, converted it all. So instead of doing one by one. So actually, if you do NPV, it's negative 1550, all right, plus 180 divided by 1 plus 12, 1.12 power of 1, 240, 1.12 power of 2, and etc. So this discount factor is basically converting it to like this. Negative 1550 plus 180 times with 1 over 1.12 power of 1 plus 240 times with 1 over 1.12 power of 2. Okay, so this figure of 1 divided by 1.12 is actually 0.8929. This is 0.797. This is the factor ni. Can see, no, Asha? So this is basically just counting the power. Okay, the discount factor. 1 divided by 1.12 power of 1, 1 divided by 1.12 power of 2, and so on and so forth. So it's easier once you use, if you have Excel, if you can use Excel to do your exam question, this will help you a lot, very fast. If you don't have Excel to do it for you, you need to use a calculator. Okay, and when you use a calculator, you need to do one by one. That is going to be very long. Okay. Actually, like this case, we actually already round it up straight away. So decimal point, depending if you are setting this like this, and we're standardizing, we're not using any decimal point. Okay, straight away convert into 000. Then recommended is 2 decimal point lah. But if you do it in Excel like this, you can forgo the decimal point. But discount factor is best for you to keep 4 decimal point. Okay, even this one is not accurate already. All right. It should be 4 decimal point. Okay, for discount factor, you need to use 4 decimal point actually. Then you only can get the actual figure. Can So can we use Excel during exam? We can use, should we color the negative figure as red like you did, or should we insert negative figure? Okay, you can color it in red, or you can put it in bracket. I don't know about whether who gonna mark your paper. If I were to mark your paper, I can accept it in red color. But if not, a negative figure, you put into a bracket like this. This represents negative reading. You see, I put the bracket, it become negative automatically. Okay. Because I know putting negative there is very hard. Definitely they'll screw up your counting. Okay, so you can use red color. I don't mind if I'm the one that marking. Most likely I will mark. If not, you can just put a bracket like this. If it's a negative, February, can if I'm not mistaken, I think you can use Excel, but I don't know because CE expectation. You look in your module leader, see what your module leader tell you. All right, some unit they allow you to use Excel, some they don't let you. So I don't know about this unit. Actually, advanced corporate finance, this is the first time I'm dealing it with your lecturer. Okay, first time I'm working together with your module leader. So I don't know what is her style. All right, and this is also a unit that they check it to me. I usually teach corporate finance only. Corporate finance, F&O, intro to finance, derivatives. I teach a lot of things. So it's quite messy lah to me. I don't know who is who, what is what. Sometimes I'm mistaken. Okay, so hopefully, because I think advanced corporate finance is a bit dry, a bit lengthy, a bit boring. So a lot of explanation that I need to do for you. Hopefully you can follow me. If you could not follow me, please go and revise. Okay, please watch back the live stream that already being live, that being shared there. You can watch it again in future or whenever that you think that you needed to understand these questions again. All right, so let's move on to the last question then. Okay, since there's no one asking me about this question, we move to the last question now. So this last question is actually very easy. You straight we need to count the EAC. Okay, so we count the EAC. So low energy light bulb costs you 350. Okay, it costs you 350 at time 0, and you have a life of 9 years. Okay, 9 years lifespan. Each year, okay, electricity will cost you $1.60. All right. This is for low energy light bulb. Conventional light bulb costs only 50 cents. Okay, but it can only last 1 year. So every year you need to change. And then the electricity usage is $6.60. So it's expensive. All right. So if the real discount rate is at 5%, so 5% discount rate, what is the, what happened? So what is the equivalent annual cost of the two products? You want to find the EAC for these two products. All right. You need to find the EAC for these two products. Okay. So first of all, put it into a timeline. I already calculated the PVA as well. Easier, make your life easier. If not, you need to count one by one again, like just now. Okay, count one by one, count your PVA. All right, for low energy, you get 14.87. Whereas for conventional, it's only for 1 year. Okay, so the costing will be 6.79. All right, so you have your present value already, or in other words, this is also your NPV lah. You already got your present value. Present value for low energy is 14.87. Present value for conventional is 6.79. So you want to find the EAC of low energy. Okay, you're going to find the PAC of low energy is basically your present value divided by your PVIFA. Okay, your present value straight away put 14.87 divide by your PVIFA of 5% and then for 9 years. 5% and 9 years. So look at your PVFA table. Again, come back again, this one. 5%, 9 years. 7.1078. 7.1078. Okay? So 14.87 divided by 7.1078. Use calculator. 14.87 divided by 7.1078. You get 2.092. Your EAC is 2.092. So this should be in dollar. So it should be only 2 decimal point. $2.09. Okay? $2.09. Now count EAC for conventional. Present value 6.79. PVIFA 5% for 1 year. So 6.79. PVIFA 5% for 1 year. How much is it? 5% for 1 year. 0.9524. Okay? Divided by 0.9524. You get 7.12. 7.129 again, so 7.13 lah. So $2.09 is cheaper or $7.13 cheaper. So which one got lower cost? Of course, conventional. Okay, or sorry, of course is the low energy light bulb. It only costs you $2.09 per year. Whereas if you use if you use this conventional light bulb, it actually costs you $7.13 per year. Okay, it's more expensive because every year you need to change bulb. Although the cost of it is only 50 cents, but every year you are changing bulb, and then it costs you higher electricity bill. Whereas for this low energy, one-time investment of $350, but it can last you for 9 years, and it's cheaper on the electricity bill. So at average, you're only spending $2.09 per year. Whereas for this conventional one, you are spending $7.13 per year. Ken, this is very easy, right? Okay? Cannot? Any questions? Are you okay? Oh, 35 participants. So many students are this class. All right. Okay, Flavi got no question. Eden got no question. The rest